let's discuss regulations, because you've been hammering on it, and rightly so. Let's start with your numbers on IPOs before, after, and what the implications are.
Well, it's pretty clear, and this isn't an academic study, and I can't say that it is, but the 5 years before Sarbanes-Oxley was introduced versus the 5 years after Sarbanes-Oxley was introduced. So you get 97 to 2002 prior years, you get some awfully good years in the market, then some bad years, and then 02 to 07 you have bad years, then you have good years. The number of IPOs that raised $100 million or up to $100 million dropped by 2/3 in the 5 years post Sarbanes-Oxley. And we've just done serious damage, I think, to public market capital formation in this country, to the point where no one views going public, raising just $100 million as a viable option. Very few people even consider it. Most people run from it. And I think it's had a very negative impact on job creation in this country. And that started in, I guess Sarbanes-Oxley went in, what I say, 2002. Yep. So it was after Enron and WorldCom. And of course, we always try to address the last crisis with a new set of rules that fight the last war, and we do nothing to address the real issue. In Enron and WorldCom's case, people that are going to cook the books are going to cook the books. There's nothing you can do about that. But
paper walls aren't going to work.
Yeah, they're not, and ultimately they'll be found out, and unfortunately people lose money in those kinds of situations. But it's not something that deserved the complete overhaul of public company reporting that we did in Sarbanes-Oxley, to the point that it has discouraged companies from going public. We have a active private equity investing arm. We sold 4 companies this past year out of about 30, and not one of them even contemplated going public. They wouldn't even think about it. So they were sold to other industry players, or in some cases other private equity firms that had an interest in that field. And I don't know what the answer is. There's a bill in the House now that's been passed to undo some of the burdens of Sarbanes-Oxley for companies with revenues up to $1 billion. My response to that is, why stop there? I mean, it's $1 billion in revenue. Well, why not for everybody? Yeah. I mean, it's a burden that's ridiculous. And of course, now we have Dodd-Frank staring us in the face.
One thing on staying with Sarbanes-Oxley, IPOs, are any of your clients, or do you see other firms considering, say, listing in Hong Kong or some of these other exchanges around the world? Is that starting to emerge on the horizon?
Well, we haven't seen our clients do that per se, but if you look at the statistics, the number of U.S. firms listing overseas now outweighs the number of firms that are listing in this country. And when you go pull up the market caps, that's who we're talking about. It's not really big companies. It's people fleeing the regulations of the U.S. and it's easy to do. And why wouldn't you do that? And you're going to see an increasing number, I think, of private equity firms and hedge funds do the same thing. I mean, why should they be domiciled in the U.S.? They're doing their business worldwide. They can be located somewhere else where it's much more friendly from a regulatory standpoint. And I think companies are going to do exactly the same thing. I noticed Aon is moving their headquarters from Chicago to London. We don't really think of moving to London as a good idea for taxes, but when you look at their worldwide business and what we in the U.S. try to do in taxing all their worldwide business, It makes perfect sense.
Now, what's one number on that? I think when Sarbanes-Oxley was passed, they said it would cost a firm $91,000 to comply.
Yeah.
So it sounded like the original estimates of Medicare in the 60s,
right.
$1 billion a year.
Right.
Now it's hundreds of billions.
Right.
And of course, it's upwards of $3 million a year, which for a small firm is a deal killer.
It's a deal killer.
Now, on
is.
What impact do you see Dodd-Frank? Obviously, the regs are still coming out.
Right.
But do you get the feeling whether they would admit it or not, this is going to kill community banks, small banks?
I think how you make money in the commercial banking business is very uncertain going forward. The ability to make money in credit cards is pretty much, well, it hadn't been eliminated, but it's been damaged severely. The ability to charge on loans and who you lend money to and who you don't lend money to, I think is going to continue to be impacted. I'm afraid you're going to see only the largest banks be able to figure out a way to make money because they can do it and spread it over a large enough base of assets and customers to make a very small spread on their loans and on their other services that they offer. I don't think that's going to happen for community banks. I just don't think they're going to be allowed to do that.
Do you feel that Dodd-Frank avoided some of the real causes? Obviously Fannie and Freddie, they didn't do very well and seemingly and too big to fail. Didn't do the uptick rule.
Yeah, Dodd-Frank looks like to me just they ignored what happened and what the causes are, and the regulators are grabbing for as much power as they possibly can, and they're getting away with it because it certainly was a financial crisis. But my view of Dodd-Frank is it has nothing to do with the causes of the financial problems that we had in 08 and 09. It really is a lot of, I'd say most of it is based on the subprime mortgage market that we created and encouraged with a lot of regulation and a lot of GSEs, with the GSEs backing and government support and government encouragement.
Do you worry about FHA?
I do. FHA, if you look at the numbers, is every bit as broke today as Fannie and Freddie. And they're essentially doing the same thing. We haven't learned at all that making people put down, let's just say 10% on a house is really a very good idea. I would like to see 20. Texas had a rule that you couldn't have a mortgage of more than 80% of the loan of the appraised value, and it has served them very, very well. In spite what Texas bankers tell me, they tried for years to get it overturned, and the legislature wouldn't let them do it. Good for the legislators. They knew some prudence was appropriate there, and now they're all very happy, and the Texas banks look very healthy.
Your bigger brethren, do you think we're in a world in terms of your business where size doesn't matter as much anymore because you're not going to be able to leverage the way you have in the past? Or how do you see big firms behaving these days?
Well, they're all banks. I mean, Goldman Sachs and Morgan Stanley have converted to commercial banks. Merrill Lynch is owned by a commercial bank. I don't know how they operate, but I don't see their business model that they used up to 2008 has gone away, and I don't know exactly what they're going to do going forward. Our view about asset size has always been, we'll compete with our brains and we'll compete with our ideas, and we'll let other people compete with asset size and balance sheets. I think we're going to be proven right in the long run. We've certainly been proven right, I think, to date, that asset size is not something that is...
Do you see more competition coming in your field, or is it because it doesn't show up on the radar in a lot of these bigger firms, they're leaving you alone?
We're not really seeing competition. And I have to think part of that is we've created a regulatory environment where people can't go off and start up boutique firms and effectively compete because they can't comply with what they have to comply with, the regulations. So while that's good for us in the short run, that's not good for the country. I mean, that's something that, we're not afraid of competition, and I would rather see, as you see firms merge, you don't see groups spin off and start their own firm. You just don't see that anymore. You used to see that all the time. I would prefer to see that than frankly, for the health of the country and the health of the economy, I'd rather see that, although right now we're seeing great people as a result of that, and it's a boon for us. But long run for the country, that's anytime you reduce competition in any area, that's not a good thing.
And what are the primary regulations you think are keeping those startups from?
Well, they really go back to the global settlement, where Wall Street was slanting research in order to gain corporate finance business. And those firms were appropriately punished for doing that, but then they applied those standards to the rest of the industry. And it's so silly, but our research department and our corporate finance department can't even go to dinner with the same client because that's viewed as some sort of conflict. But the idea where you had a firm that followed someone in research, traded their stock, and hoped to do their corporate finance business has pretty much been eliminated with a handful of exceptions, us being one of them, partially because there's no way to pay your research people. Part of the global settlement, you can't pay them out of corporate finance fees. Well, the commissions have gone to almost zero. So how do you pay them? Well, you must have a big enough commission base to where you can pay them and your customers are willing to pay you. But what we've done, in our view, is those research people that aren't adequately compensated in their view have left the industry and they've gone to hedge funds because they can be paid, and the hedge funds aren't subject to best execution rules, and they can pay someone a nickel or 10 cents a share on a commission if they want to. But that research person can be compensated, so they've gone to where they can be compensated, and we've driven them out of the public marketplace, all in an effort to help the individual investor. And now the knowledge is almost walled off from an individual investor. Most individual investors can't qualify for a hedge fund. They're left with the mutual fund world that is less and less inclined to get the first call or the first series of calls from any investment bank, because you call your best clients first. Who are your best clients? In every firm, it's an increasing number of hedge funds, not the old mutual funds that manage the bulk of money for individuals in this country.
Quickly give your critique of things like Regulation FD, full disclosure, which has actually heard it.
Right.
Selling decimalization, best execution. How have those things, in the name of helping us, ended up upending the industry?
Well, FD has made getting any information out of a company much more difficult, because where if an analyst were to ask a question of a company, if in a one-on-one situation, and just he happened to ask the right question, he'd done his research, he'd hit on the right question to ask, so to speak, the company almost can't respond unless they then go respond. Well, they can't respond unless they go respond to everyone. Well, as you well know, in this day and age, if you respond to one analyst and he puts it on the website or publishes it shortly thereafter, the world knows. They didn't have to go to, make some press release, but there's no reward for that research analyst doing the work and thinking of the right question, because the company can't answer. Decimalization and best execution. The SEC was focused on years on commissions in the name, I guess, of driving the transaction cost as low as they can. And so we used to have an eighth, 12.5 cents, and we paid in a commission, and we paid for research, and we paid salesmen, and you even paid traders out of that. And we've driven that to pennies at best. And again, with that money disappearing, you've had professionals leave the investment banking world go to places where they can be compensated, like I was saying in the hedge fund world. And so access to information has been restricted, not improved by that. And you've also created a situation where there are no humans really involved in the bulk of trading. It's algorithm talking to algorithm. And I'm a big believer in electronic trading. I'm a big believer in the power of computers, and I'm also a very big believer in having a human being somewhere involved in that process that gets compensated. And if you'd have had that, I think you'd have avoided the flash crash of several years ago when $1 billion share order shows up in one of the systems and they start executing and all the other algorithms respond to it. Instead of that going to a specialist on the floor of the New York Stock Exchange who says, he doesn't mean sell 1 billion shares. Get that guy on the phone. What's he mean? He doesn't mean sell 1 billion shares. This is an error. And instead, we have this violent move in the market that gets corrected just about as gets corrected just about as violently going up that could have been completely avoided if there had been a human being there. And best execution is the same thing. I mean, we may give an idea to Fidelity that they don't have from anyone else, and they can't execute the trade through us because they have to be able to prove to their regulators that they executed it with the person that had the tightest spread in the market. Never mind that the idea that they had nothing to do with the idea, that they had nothing to do with doing the work to get it there. Well, again, are we going to call Fidelity, who can't pay us? Maybe, but they're just cutting us a check at the end of the day now instead of executing to us. And it was frankly a better way of doing it before. It was much more cause and effect related, as opposed to now you get a check at the end of the day and you hope it was because you got votes in their research votes, and that's true, you did, but it doesn't help our people see the cause, the cause and effect of their research has been lost a little bit.
The volatility, is there any way to put the genie back in the bottle? Some say transaction tax, others say that's just going to drive it elsewhere, and you can't undo it with technology.
Yeah, I'm not a fan of any tax on anything, and I would not advocate a transaction tax. I think with particularly high-frequency traders, I think you can do some things in making their bids and offers good for a longer period of time when they come in.
Like
and
1 second?
Yeah, like 1 second would be remarkable. And they tell me that there are algorithms that they have in their programs that create the volatility. Well, I'd take a hard look at that. If you have algorithms that are creating the volatility, let's see what that is and what it does, because that's how they're making their money. And of course, the stock exchanges would be opposed to that because they're making small amounts of money on that. But for investors, volatility is not a good thing. I mean, if you're a long-term investor and markets move 2% up or down in a day and nobody really knows why, it doesn't inspire confidence.
Why has nothing really been done or hasn't been done on the uptick rule?
I cannot tell you that. We've talked about that before. It's one of those things. I didn't even know they'd undone it till the 08-09 crisis, and they were talking about reinstituting it. And I said, well, when did it go off? I didn't know that. That's a crazy rule. I mean, the uptick rule is a very good rule. I mean, just the logic of it makes perfect sense, and why we would undo it, reinstate it in a time of crisis, and then undo it again is beyond me. I have no idea. It ought to be reinstated yesterday.
One final question. Any desire at some point going in the public square?
Oh, well, I'll speak out about issues in regulation. If you're asking about politics, probably not. It's not one of those things that I'm having a great time in our business, and I'm probably not cut out to be a very diplomatic politician, but I may be cut out to be a pretty good businessman. So they probably don't go hand in hand. With you, they did pretty good, and I hope with Mr. Romney they do well too. But I don't think that's really for me.
Warren, thank you.
Thank you, Steve. Appreciate it.